Hey guys, my name is Fyzee and this video is going to be a short overview of ASX NDQ. This ETF tracks the NASDAQ-100 Index. Before we start, I just want to say that this is not financial advice. I'm not a financial advisor. We are speaking in a very general sense only, and I just have a passion for investing, same as you, so let's get into it. So NDQ stands for Beta Shares NASDAQ-100 ETF, and this ETF basically gives you exposure to many of the world's most innovative companies that are revolutionizing our everyday lives, like Apple, Amazon, Google, and more. Now, the objective of this ETF is to, of course, track the NASDAQ 100, which we spoke about earlier, and this actually tracks the largest non-financial companies on the NASDAQ over in the US. So some benefits of this ETF is that, number one, you can basically invest in the way you live. Now, what they mean by that is that the top companies like Apple, Amazon, Google, Netflix, etc., since you're using their services nearly every single day, you might even want to invest in this sector. And secondly, this ETF is giving you exposure to the new economy. So if you guys didn't know, over 50% of the companies in the NASDAQ 100 are tech companies, which makes it a pretty exciting ETF, but it's also a risky one because of the recent tech sell-off which you would have seen. But nonetheless, it still gives you exposure to that technology because here in Australia, technology is a very tiny sector of our market, and you might want to get diversification in that area as well. And number three is basically simple access because you only need to buy this one ETF to get exposure to all of these 100 companies. Now, the fees for this ETF are 0.48% per year, which isn't very low if you compare it to other ETFs, but we'll speak about these fees in just a second. Now, also with this ETF, you don't need to complete a US tax form, which just makes our lives a bit easier. Now, looking at the returns for this ETF, you can see that there has been a bit of a sell-off going on right now, where this ETF has dropped nearly 10% in value. But if you look at the chart for, let's say, 6 months, the return is actually quite decent at about 7.3%. And looking at a 1-year return, it is quite nice as well at about 35%. Now, it's important to note that the 1-year return is tracking it from March, which was last year, which was the actual sell-off. So the return is going to be quite huge. But if you look at the 5-year return, it is somewhere around 173%, which is just phenomenal. Now, it's very important to note that this ETF has done quite well over the past 5 years because it's heavily geared towards technology, and we'll discuss this in detail later on. Now, these returns are all good, but let's find out the compounded annual growth rate of this ETF. So here I've got the compounded annual growth rate calculator, and this calculator gives us an annual return which is compounded. So let's have a look. So the starting value of this ETF is going to be $10.04. So let's just type that in. And looking at it right now, the value is 27.42. So let's put that in. Now, this chart over here is a 5-year chart. So when it comes to the years here, we're going to put down 5. And let's calculate and see what our returns are. As you guys can see, the return is a massive 22.26% per year. So if you invested any sort of money 5 years ago and you held it up until now, you would be getting a compounded return of 22% per year. Now, this is obviously insane because the market average is less than half this, and it definitely beats your savings account. Now, it's very important to note that although the past return has been absolutely phenomenal, we can't really expect this return to go moving forward. So it's very important to have the right expectations. And additionally, through COVID, we've seen a lot of people working from home, so a lot of tech companies have done quite well. Now, guys, if you want to get started with investing into this ETF, I would recommend SelfWealth or Perla. Both of these platforms are Chess sponsored, and if you want to get started, there's affiliate links in bio where you can get a free trade to get yourself started. Now, here you've got the net assets and the units outstanding, and if you divide these two together, you will get the unit price, which is over here, and the management costs are 0.48% per year, which we spoke about earlier. Now, if you're looking to invest in strictly broad market ETFs, like the ASX 200 or the S&P 500, then the management costs for those ETFs are going to be significantly lower than this ETF, and usually speaking, they will be around less than 0.1% per year. But the costs for this are 0.48% per year, which means that you'll be paying around $48 per $10,000 invested. Now, the distribution frequency over here means that how often they pay a dividend, and in the case of this ETF, they pay a semi-annual dividend, which means that you'll get a payment twice a year. Now, looking at the trading information, you've got the ASX code here, which is NDQ, the trading hours, all pretty standard stuff. But here are the portfolio holdings, which are the most important part of this ETF because these allow us to actually see what this ETF is tracking. So the largest holding is Apple at 11.2%. Then you've got Microsoft at 9.6%, Amazon at 8.4%, Tesla 4.3%, and so on. So you guys can already see that 8 of these 10 companies are directly related to tech, and if we add up these 8 companies, as in if we add up the weighting of all of these 8 companies, that is just under 40% of the ETF's overall holdings. So basically you can see how skewed this ETF is towards technology and how concentrated it is as well. Now if you click this link over here, you can see the full allocation of the companies in this ETF, so you can obviously get a better understanding. Now let's look at the sector allocation, which is over here. So first of all, obviously the whole theme of this ETF is technology, so we can see that nearly 49% of this ETF's sector allocations are in technology, and there is very little allocation towards other stuff like communication services, which is 19%, which is less than half. Then you've got consumer discretionary, which is 18.5%. Now if we actually compare this to an Australian ETF like the A200 ETF, you can see that for us only 4% of the ETF's holdings are in IT, which just shows you the insane difference between Australia and US. So if you guys want to get further diversification, also think about investing in other countries as well, rather than just Australia. Now here we've got the fund returns after the fees. Now we already went into this a little bit, but you guys can see it here again. And one important thing to note is that this ETF has only been listed on the stock exchange for just under 6 years, as it was listed in May 2015, so the average return can still change over time. Now this ETF does have a few negatives if you think about it, with the biggest negative being that it's not really diversified. Because of the heavy leaning towards technology, you might want to think about if this ETF is the right option for you, because technology can sometimes be overvalued and pricey, so you might want to think about that. Now guys, if you're only investing in the Australian market, you might want to diversify yourself and invest in the NDQ ETF, or you might want to invest in an ETF like this, which is IVV, which tracks the S&P 500. Or you might want to diversify yourself into Asia, and this video breaks down the top 4 ETFs that you can consider to get exposure to the fast growing regions of Asia. Thanks for watching guys, please like and subscribe, and I'll see you in the next one. Bye now. Now if we actually compare this to an Australian